So let's take a look at financial trending year to date. And on this screen, at the top of the screen, you currently have the year to date totals for the year, the current fiscal year for revenue, cost of goods, margin, operating expenses, and then the calculation of EBITDA. The first section I want to be going through is a revenue section. The revenue section is set up to give you a feel for how revenue is performing on a monthly basis. So here I'm seeing the months associated with my fiscal year. I'm seeing in thousands of dollars how individual revenue has been performing through the year as comparing to my plan number. So this information, along with most of the information that's on this sheet, is coming directly from the Financials Current tab. So I mean, one of the interesting things, just to show it to you now in terms of it, because we're looking at the monthly revenue plan, is to go over to the Financials Current, and you can kind of see where, starting in May, it seems like we've really kind of taken a jump up. So I had 220 as being my target in May. So let me go over to Financials Current, and one of the things that you're going to see as you go down through and find your total revenue number is that if I go over and I take a look at my current targets, and you can kind of see there's my May, which is my 210 target. And as a starting point, we put some numbers in here just so that you could calculate and see some numbers. But one of the things about everything that's in green is that we expect that those numbers are going to change based on your plan numbers. In fact, I would even say is that probably someone would go in and start saying it's 400,000, right? And by just changing these numbers, and these are part of your plan numbers for your total revenue on the Financials Current, you're going to come back and see that kind of change. And likewise, what you're going to see as well is you're going to see a change in the cumulative numbers, because cumulative is just going to take all of the data that's indicated here and come up with a cumulative total year to date for that month, along with the plan numbers. You kind of see how you're doing. And in fact, I haven't put any numbers in this demo data for October, November, and December, so you can kind of see that that levels out. So that's basically how straightforward it is to change the numbers associated with the revenue and the plan. So let's take a look at some of the other financials that we have on the page. One of the things that we do is we do a year-to-date revenue by contract type. This gives you an indication by the level of a contract type over the course of the year what percentage, in this case 84%, came from recurring service. That's helpful because a lot of people are looking at what types of revenue, what types of different revenue do I have that constitute my overall revenue. And so we also provided for each month what the total dollars happen to be. In this case, you can see this large increase in terms of the revenue for recurring service. My recurring revenue service is growing in this case. We also provide the average revenue per client. Average revenue per client takes the total revenue for a month divided by the number of clients you actually invoiced in that month to come up with an average revenue per client. This is a good indication where you can see whether or not you are going up market, per se, or are you dealing with a lot more clients that have smaller dollar figures and your average is going down. Gives you that kind of indication overall, which kind of is a nice trend. We also provide, specifically for recurring revenue, what percentage of the total happens to be associated to the overall revenue. And a lot of people look at managed services and they know that they want to move into managed services. They want a larger portion of their business to be recurring service revenue, because it's a monthly commitment. You know that the dollars are coming every month. This is a nice indication that indicates it's a stable, recurring source of revenue. In terms of, we talked about the average revenue per client, but the distribution is also important. In this case, what we do is we take the revenue and we say how many clients were in the 1 to 1,000 area, how many clients were in the over 10,000. And what you do is you get a visual indication where I can actually see that although in the beginning of the year I had 3 clients that had on a monthly basis were paying me over 10,000, at the end of the year I actually had 15, or I should say at the end of the year, at the end of September. So I can see that growth in terms of large clients. And so although I can look at an average, this kind of tells me how my segments are growing or changing in terms of the clients that I have. This is all based on number of clients, but as you know, is that's all, what's also kind of interesting is to see what overall revenue is associated. Even though this represents 15 clients, you can actually see it represents probably almost 40% of my overall revenue. So those 15 clients represent, those 15 clients of the like 85 that we have total, represent almost 30% of my overall revenue that's being generated. In fact, when you look at the clients that are actually in the 1 to 1,000, they're actually in they're actually below. They're not even showing up on the scale here. What we also provide is year-to-date the top accounts by revenue, because it's important to know who are the clients that are generating the most revenue. This shows you the top 15 clients, also in terms of thousands of dollars. So you can take a look at these clients kind of just as a year-to-date total. This will always show you the current calendar year. It doesn't work on a fiscal year basis, so if you're doing June to June, this is always showing you in terms of January to December revenue. Just making a note for those. That's also in our release notes. The next section is on cost of goods sold, and cost of goods sold is all about what was the costs that were directly associated with providing the service. So it's not sales time, it isn't administrative time, it's not HR time, overall management. This is the time that actually was spent on the project, on the ticket, to actually provide the overall service, and any costs that were directly put onto the project or the ticket or the contract or the task. So what we wind up seeing here is we see a cost of goods sold per versus your plan targets, and this is where you're actually trying to manage how much is being spent. So you can have a target for that as well in a cumulative year to date. Oftentimes, if your revenue is higher, you're going to have some higher costs. So these kind of go hand in hand. Likewise, similarly, we show you the cost of goods sold associated to various contract types. Interestingly, before we saw that 80%, 84% of our revenue came from recurring service, but you can kind of see is that only 58% of our costs come there. So you're going to get a feel for where the margins are going to be, what the margins are going to be showing. And overall, what it's also showing you is it's also showing you the cost of goods total over the course of the year. And as expected, we increased the amount of revenue that we're getting from recurring service, so we would have expected that there was an overall increase in the recurring service, but fixed price was probably higher than we thought in terms of the fixed price contracts. So that's kind of the cost of goods sold. That revenue minus the cost of goods sold is giving us our gross margin. Here we see our gross margin in terms of plan. You can kind of see is kind of a weak start, and it builds up towards the end of the year. And as expected, maybe we weren't planning on it, so even though we were expecting a little bit of a jump, a lot more of a jump occurred. So you're seeing this is really kind of, if I take my revenue and I minus the cost that it did, this is the amount of money that's left over to actually cover a lot of those costs, like sales and marketing costs, specific development costs that may be associated, or administrative costs. Again, we see the per margin per plan, but we also see if we were looking at September, I could say, well, my cumulative gross margin was, well, in this case, 2.7 million. My plan was for like 1.06 million. So not bad, doing very good in terms of the overall plan, if this had been my plan. Year-to-date margin by contract, 95% of my margins are coming from recurring service. So probably isn't going to be, this is again demo data, but not going to be that kind of pronounced, but that's what you would expect, is that a higher percentage of your margins are going to come from those kind of areas. I also see a gross margin by contract type, so I can see where the overall dollars are coming, and overall you can kind of see that it really is coming, because we expect 95%. You're not seeing much of the other contract types showing it. My average client gross margin, nice to see that it isn't simply that we are scaling and getting more revenue and our costs are remaining the same. We're actually seeing that on average the amount of money that each client is giving us on a per monthly basis is increasing. Likewise, as important it is to see the average, we show you the margin distribution. And one of the things in the next video we'll be showing you is how you change all these distribution buckets. One of the ones that's kind of important is how many customers did I lose money on. So in September I lost money on 6 of our customers. And people think about, you should never lose money on a customer, but in recurring service models there are going to be some months that you probably are going to lose money because they in fact have an insurance contract that says this is what I'll pay every month, and some months you may make a lot of money off of them, and some months you may have to spend a little bit extra in terms of servicing them, and over the course of the year clearly you'll make out. One of the other things we'll show you here is your year-to-date top accounts by gross margin in terms of thousands, but just as important to know where you're making the money, and these are your kind of top clients. I often say is that it's important to know who's giving you the most revenue, but it's also important to know who you're keeping the most money after the job is done, and that would be in terms of gross margin. Interestingly, if you went back up to the revenue, you could probably look at like seeing it was CYN South, Lindsay, and Communication Systems, right? Well, if I go down to my margins, which is kind of where I would really be more. No, see, these two are Lindsay is 2, and that CYN South is second. So they've actually flopped in terms of who's giving me the most. What's also important is to know your bottom accounts by gross margin. And so this is actually kind of showing you, again, this isn't thousands of dollars, FIM Consultants, Raven Products, IEC Electronics. These customers are customers that over the course of the current calendar year I have spent more money servicing than they have paid me. In any case, there's a couple of things you want to be looking at. Is number one, identifying why, and probably in terms of when you're renewing your contract, look at what factors would require you to renegotiate any contract. If it was all recurring service or if it was a fixed price, taking a look at how you deal with that more effectively. This is percentage of gross margin, and this will kind of show you percentages of gross margin. One of the things that you'll kind of see here, which you want to take a look at, is FIM Consultants isn't here. It's probably because what you're going to find when you take a look at the data is that they had revenue, or they had costs, but they had no revenue that was actually billed for them. And you may have some clients that are going to be like that. Their contract had expired, you spent some time to service them, and there's no revenue that's associated to it, or you didn't invoice them anything, it was a giveaway, that kind of thing. So okay that it's in, this is $200 and this is $200 and this is $100, but if they have no revenue, it won't show up as a percent of the gross margin because that's a ratio to your revenue. So that's a summary of what is appearing in terms of the year-to-date. Kind of set these things up so that each chart kind of tells a little bit of a story for you to look at. Of course, looking to see whether or not you've met or missed plan, what the trajectory is looking like. And in the next video, like I said, what we're going to do is we're going to go in and not work on changing the plan numbers, but also getting in and focusing in on some of those distribution areas where you can change and make it more tighter to what your revenue ranges might be. So, thank you very much.